What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves, 45 days, free, no risk, no friction, just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Sherman.
Welcome everyone to a special episode of Sparta Market Outlook. This week we're celebrating our 1-year anniversary. Actually, it's the 52nd episode. The 1-year anniversary will be next week, but obviously 52 seems like a better number than 53. And we're very excited about this. Having a podcast right now, actually, we have on average 500 listeners per week, more than 2,000 listeners per month, making us one of the, I would say, the top 3 podcasts within commodity trading. And that's something that you guys can be very proud of. So congrats to you guys for the content, the work behind, and the fact that actually people care and they connect weekly to listen to what we have to say and our opinions about the market. I think it also demonstrates that we're not here just to tell you what happened last week and be a reporter of past events, but we're actually making market calls. That's something that a lot of our traders and customers want from us, to make a call. And everyone understands that we're not going to be right all the time. Otherwise, we would not be sitting on a podcast and we would be trading on our own. But it's mostly around, telling what we think and why we think it. That's the critical element that I think is driving the success of this podcast. But again, congrats, guys. And so just as a way of introduction, we have today with us Phil. How are you, Phil?
I'm good, thank you very much. And I think we'll reserve most of the praise for Neil on the podcast.
Yeah, Neil, absolutely. The brain behind the podcast. How are you, Neil?
I'm okay. Yeah, thank you very much.
And we also have Hua joining us from Singapore. How are you, Hua?
Not too bad. How are you?
Very good. So before we dive in, I thought it would be interesting to talk about the format. What are the pros and cons of this style of communication? I'm talking podcast. We've seen in many other industries that podcasts are taking over Spotify, Apple Music, etc. And this content generation is something that has more and more adoption. But why is that? And why do you guys think that oil analysts and oil traders like this format? And is this going to be something that has legs in the future?
Well, I think one thing is that podcasts are very easy to listen to, like everywhere. So, like you're driving to work, you're on the subway, etc. You've got like an hour, maybe 45 minutes to kill. So just want a quick rundown of the market. You listen to the podcast, that's like the perfect thing to do while, you're trying to drive or, like stay on the subway. So like to me, I do the same thing too. On the way to work, I will listen to a podcast, our podcast. Then, so that's probably one of the reasons why, it's getting really popular.
Yeah, I think it's good to get away from the screen as well, right? Sometimes you can, it's time where you don't feel necessarily, obviously you're not having to look at your 9 screens at the same time, but you're still being able to ingest some information that's going to maybe add a little bit of context when you then get back to those screens and you need to make the decisions.
They give you 9 screens. I've only got 2 screens. That's not very fair. No, I like the flexibility of it, right? Because I feel in prior roles as a vendor, you're kind of forced on a regular kind of cadence, and you're forced to also sound like you are always very convinced by what you're writing, and you're forced to do something every week. And and you maybe don't actually have the conviction behind it. It's weekly, yeah, but you can hear it. It's more human, right? You can hear it in our voices. This week we're not that sure, and we've got doubts on this kind of level, and it's just a bit more flexible in terms of, getting that message across, which I quite like.
I actually like the fact that the reality is that most traders and analysts, you ultimately never really switch off. You always are thinking about the market, thinking about positions and all that. But when you are in the heat of the action, you don't necessarily have enough time to digest. So you're in front of a PDF file or a text, and you're sort of reading through it. You never really have that time to be quiet and listen. Whereas when you're back home and you don't want to necessarily start reading all these documents or whatever, but you want to just listen, and indeed it creates a bond with the person that you're listening to. I don't know, Phil, Hua, Neil, that you probably get a lot of customers getting back to you. Oh, I heard you on the podcast. What do you think about this? And it creates a bond. You suddenly have now your external analysts collaborating with you, giving you ideas. And as you said, Neil, I think that it is very authentic. You see, when you are saying it with different degrees of conviction, people recognize that, and that authenticity is also very important. So I particularly enjoy recording this. It also is for us, it's fun, and it creates a debate, because when you write something, you need to be, as you said, almost definitive about what you think, when in reality, life is never definitive, particularly in trading, and you want to have a debate about it. And also having different points of views on a specific matter is also very useful to come up with that trading strategy. So all of that also helps, I would say. So let's close memory lane here and go into the topics of discussion today. So we wanted to have a special episode, and instead of focusing on short-term trading strategies, which is what we normally try to do, we thought that we would mix it up a little bit this time and have a bit of a conversation around wildcard theories, going outside of the beaten track and making a bit more of a guesswork in terms of those wild assumptions that could happen in the market. And so we are into script on this one. Let's see what happens. Let ourselves go a little bit. Let's first start with what happened over the weekend in the market, because it sets us up nicely to the rest of the conversation. And obviously the first thing to talk about is that terrible jobs data, the S&P sell-off, the crude flat price sell-off, then Trump then saying that he wants to get rid of, what is the title exactly of the
Bureau of Labor Statistics chief.
Exactly, that guy. So all of this sets us up for the first topic of discussion, with, again, wildcard here, particularly in this complete dominance of the U.S. Is a potential U.S. recession approaching? Now, who wants to start with that?
I'll start, and then Hua, you can come in with the conspiracy theory, right? Because it's been one of the themes of the last 6 months that there is a plan behind what Trump and his administration is doing, right? But that what we've been discussing always, or most people, is it sounds like there is a theoretical plan, or it's possible, but it's got a very, very, very small chance of success in the long run, right? So just to frame this then, yeah, I was feeling quite bullish flat price at the end of last week, and it completely went wrong. I think lots of people had a bad day on Friday, and it did make sense to maybe sort of dip into the options market. But yeah, that jobs report was awful, wasn't it? And it just brings back the fear of, the first half was basically watching what might happen to macro and looking for early signs. And now we're going into the second half, and the fear that basically the market will just tumble due to the impact of tariffs is rising. And the other consideration is the quality of US data, right? Because it seems more and more politically driven and replacing key figures in statistics agencies and increasing the number of kind of, let's say, fake data inputs into inflation data is another one. That's not a good sign. Maybe that's a good segue for you, Hua.
Yeah, I mean, I think it's definitely interesting, and it's sort of like a wet hell moment when like you've got a firing on the BOS chief. But then, in all honesty, if you look at what we've seen over the last couple of months, maybe last couple of years, like June non-farm payrolls, that was revised down by like I think 130K jobs, which is a massive amount. 8 out of the 12 last reports have also been revised down. If you look at the CPI, you've got like these new seasonal adjustment methods for number of items running up 2024. I think since April or May this year, you've got a hiring freeze, on a federal level. So that translates to a lot less price data that's being directly collected in a number of cities. So you kind of think about it and you're like, okay, how much can you actually trust the stats coming out of the US right now, right?
So,
Yeah,
what does that make you think that this is heading into recession then?
well, the first thing is there's obviously a slowdown, right? With these revisions, there's obviously a slowdown first in hiring. And one of the ways that a recession starts is that you slow down hiring and then you start firing once things properly worsen, right? And unemployment figures so far are basically flat, but the hiring is definitely slowing. And so that is the thing that spooked the market for the most part. And then the second thing is the kind of, how can we how can we trust the data as we go forward, which is another concern.
I guess that, there's an element of time here in terms of when do you actually start seeing the impact on tariffs, etc. Now, first of all, the impact was more driven by the uncertainty of what you could or could not do, and then the second impact is the actual economic impact, and we're starting to see this, for example, in the results of the automakers. GM, for example, published losses, most of it driven by the fact that they had to absorb the additional cost of tariffs. They were not being able to pass that along to customers. So you're starting to see that at a corporate level. And ultimately, at some point, you may be able to see it at the consumption level, which, as we know, in the US is the main driver of growth. So I can see the point of that. I can see the point that because the market was extremely happy to hear that the deals with Japan, with the UK, with the EU were done, because that's really what matters, frankly speaking. Now you still have some uncertainties around Switzerland. I don't know what the Swiss did to be punished like this. Brazil for political reasons and things like that. But ultimately, there was clarity, which is what the market wanted. But now that the clarity is over or is there, what's next? The economic reality. So that is an argument I can understand. I can buy that. But is that enough? I mean, there's the counter argument, I would say, is this whole AI boom, that whether it's the AI boom or even the infrastructure boom that you will see, with NATO spending, 5% more in, 5%, of their GDP. So there's a lot of things there that are inflationary, or I would say growth driven. Can that be a counter argument?
Well, I definitely agree with you, Felipe. I think they're actually quite careful when it comes to this. I'll talk about it later on, but in a recession is bad for what they're planning, in my opinion. And I could talk a little bit about the stages they're planning. Well, a little bit of conspiracy theory here and there, but a recession is definitely bad for their plan. So then we're going to be quite careful when it comes to that. So I think from that standpoint, I agree with him.
Now, the other element is that if you look at the S&P right now this year, if you take aside all of AI sort of companies, listed companies, then the performance this year is actually quite poor relative to other markets, particularly the European market, which has basically no element whatsoever of AI. So that is also maybe telling you a story of the state of the economy outside of AI. So any stronger arguments of justifying a potential US recession other than the jobs report and the impact of tariffs? Okay, well, let's move on to the next one then. So the first one related to the Trump's tariffs grinding the market down. Maybe we want to start, talking about what tariffs means for the oil market. Who wants to start with that?
Well, I think before we even talk about what tariffs mean for the oil market, maybe it's we should do like a quick recap of what I think the administration plan for the tariffs is. And I think it's quite interesting because you've got a lot of, all these different conspiracy theories. And, of course, people also always talk about tariffs and protectionism, isolationism, all those are true, tariffs are crazy, etc. But that if you look at it, I think there is a little bit of logic to quite a number of people within the administration. And these are not even conspiracy theories because they have written about this before, if you read the papers that some of them wrote back in 2024 or even early 2025, they do lay out a pretty clear plan of what they want to do when it comes to tariffs. It's just that for the plan to succeed and, go exactly the way they want it to go, that requires nothing short of a miracle, right? So, but in terms of the tariff, to the administration, the dollar is a big problem. You've got the dollar as the global reserve currency, which does confer a lot of benefits. Obviously, people talk about cheaper borrowing costs of the U.S. government. That is true. In theory, in reality, the differential versus the borrowing cost for the other, like G7, G10 countries is actually not that much. So it is still a plus, but it's not as much as, like people often talk about. The second plus from having that global reserve currency status is a much bigger one, and that is the ability to pursue your national interests and project power beyond, like what you normally can, and that is done via the financial system. We have seen that, like how they've done with sanctions and like kicking people out of the SWIFT system. So that is a much bigger plus from the like the dollar as a reserve currency, right? But also because of that reserve currency status, what you've got is a huge permanent demand for the USD and also the US Treasuries. So the normal equilibrium mechanisms in foreign currency just don't really work that well when it comes to the US dollar. And what you have is a massive perpetual overvaluation of the US dollar. And I think, Felipe, I knew you talked about this before, and that, obviously some of the argument is that, okay, that kills domestic manufacturing, but also because domestic manufacturing is intricately linked to national security, that becomes a lot more important, especially in the world that we live in today, where China and Russia have massive industrial manufacturing base themselves. And in terms of that overvaluation that we talked about, the premise of that was, the foundation of that was post-World War II. And back then, America contributed like 40% of the global GDP, whereas today it's more like 25, 26%. So that overvaluation of the dollar becomes a much bigger problem now than it was, in the decades before. Okay, and I talked a lot of words, but like, what does that even mean? Like how I think the administration looks at correcting this sort of overvaluation of the dollar is in two stages, and it has to be in this sequence. And you also have to keep in mind that they do not actually want to destroy the system. They want to keep that reserve currency status. They want to keep the system. They just want to improve their own position within the system itself. So it's and like the stages, you've got stage one, which I think is probably the first year, maybe a little bit, maybe first 1.5 years into this administration. And stage one is all the tariffs, that we have seen. And the main point of having tariff is to use the tariff as leverage in their negotiations with the rest of the world. And the negotiations could come in terms of trade balances, their security commitments, sort of like a carrot and stick sort of approach. And then and you've seen that they've tried to do that, and you've got a bunch of countries that have fallen in line. But within this first stage, the administration expects the dollar to actually appreciate a little bit, and that sort of cushions most of the impacts from tariff. Like Felipe, you talked about like GM taking a hit on some of the margins just now, right? But if the dollar is actually a little bit stronger while that is going on, it actually helps cushion a lot of the impacts of the tariff. So that's stage one. And then you've got stage two, which I think is probably the second year onwards. I call that the currency stage, where they try, like they've done all the tariff, they've gotten all the countries in line, like they've gotten the security commitments that they want to have. So now it's time for them to sort of start engineering a weaker US dollar, which would actually help correct the trade imbalances and like reshore some of your high value added manufacturing. So where we are right now, we're still in stage one. How that has turned out actually quite interesting. Like half of that has turned out to be what I expected. You've got countries falling in line, like making all of these different, like commitments to defense, security, etc. The dollar is going the other way though. So you've, like instead of people expecting the administration, expecting the dollar to maybe appreciate a little bit, it has actually depreciated since the start of the year. And what that means is that, like obviously depreciation of the dollar can actually make inflation a lot worse, like in general. And if it's a one-time sort of inflation, doesn't really matter that much, but it's all about the expectations, right? So the expectation of inflation is important. You've got, we talked about the wage price sort of inflationary spiral before, and like that is a very real possibility when you have all these things going on.
I understand the logic. So you want to, in essence, what you're saying is that within this strategic mindset of saying we want to onshore back the manufacturing for either economical or geopolitical or strategic reasons, you are, first of all, fighting these imbalances by creating these tariffs and also asserting your power, so that you then create a situation where building in the US now it's more economically, or there is more of a parity relative to other countries. And then you want to, and for that, I don't know if you want to have a strong dollar or not, but what you definitely want to have is a weak dollar once that production is in play, so that you can be competitive
Right.
on a global stage. But
Exactly.
so why do you think the dollar has weakened so much? Because we've had the worst run in the dollar, particularly against the pound or the euro over this year, or versus the last 20 years. It's been the worst momentum. Why has that happened?
Well, I think that's one thing that they probably didn't take into account that much. They expected the dollar to appreciate, instead of depreciate with the tariffs. But now, because everybody is expecting, say, like weaker growth overall, and like a much, like dollar global kind of picture when it comes to economic growth, that actually has an impact on, like the other way around. And I think that's like probably one of the main reasons why it has gone the other way, that like opposite to what they expected.
So it's, in a way, what you're saying is that the market was expecting that, as we saw with Liberation Day, where the market collapsed, was the fact that introducing all of these tariffs will ultimately have an impact on an economical perspective, with lower demand, higher inflation, which ultimately drives lower growth. And therefore, you're not even addressing inflation or interest rates because the inflation is higher. At the same time, you have a lower growth because you have lesser demand, if you want. And that leads to a weaker dollar. Is that what the market is calling?
I think so. Yeah, I do think so. So in terms of like the currency is sort of accelerating way beyond what they originally expected, right? So we talked about, like stage one of maybe a little bit of appreciation, and then they start engineering a weaker currency, like once everybody has fallen in line, you've made all your, you've done all your negotiations. So it went ahead of that. So instead of going up a little bit and then going down as they expected, it just, like it went all the way down. So,
yeah.
So that's...
No, it's interesting. I mean, you obviously, if you even listen to the FOMCs and the statements from the Fed, they were still quite hawkish. They were not talking the bullish game that Trump wants them to talk. They're still very concerned about inflation right now is at a good point, but I think that they're still concerned about the economic impact, and that is. I think the market is seeing that, and that's why the Fed is not necessarily reducing interest rates, because of the concern around inflation. But I don't know. So, Neil, it seemed that you wanted to intervene.
No, I think we should. How do we link this back to oil? Do we want to say? I mean, one thing that we have on the list is weaker dollar usually correlates with stronger oil prices. Is that something that we have seen? Is that fair this year? Do we have anything that we can really say about demand ex-US?
I think that correlation is true most of the time, simply because most of your oil trading is denominated in US dollar, right? So weaker dollar usually corresponds to stronger oil. But now, as Felipe said, you've got all these expectations about slower growth, and also kind of like the Fed's desire to keep inflation down. So you really have to balance that against all of these, like these expectations. So it's you're kind of like, I think if you talk oil, it's kind of like caught between all these opposing forces, which to me just means, well, I know it's not really interesting to say this, but it means it's going to be range bound, right?
Flat price can't do anything. Same as all year, basically. Stuck in a narrow band.
Okay, so any other comments on the impact that it will have on oil? I mean, I guess that it's not just the dollar impact, but also the relationships between the US, China, etc.
No, I would maybe just couch it by saying there's still a lot of the. I mean, you remember the start of this year, right? The start of this year was, even before 2025 started, the market's going to be massively long because demand's going to be crap and there's going to be loads of supply. And it's just not really happened, right? And the same narrative is popping up again in terms of the market's going to be massively long in Q3 and Q4. We haven't really seen it in the inventories still. So I just, in all honesty, I have no bloody clue like what demand is going to do on the back of all this stuff. And I know that the agencies are still predicting relatively weak growth. And I tried to explain a few weeks ago, it's one thing to sort of predict weak growth in terms of total oil demand, but they don't even really understand what's happened in H1 yet. And the big sort of, let's say, conundrum in the market is kind of two things. There's still in the oil stats, a big stat diff, statistical difference. That's the difference between what the balance looks like on paper and what's happened to stocks. And the other thing is that there's been big builds in basically crude stock in China this year. And the weird thing, which is kind of not a conspiracy, but you've had China almost exactly mopping up any surplus that might have shown in the OECD, right? Which is kind of, I don't think I remember that ever happening. Basically, let's say we were kind of 300 long this year, China mopped it up and nothing showed in the OECD. So what is the purpose of the kind of supply-demand balance when you kind of look at China and they're strategically buying when the price is right and they're mopping up the surplus and the barrels will never make it out, never see the light of day again for the next couple of years? What is the, what's the outlook there? It's kind of like, I have to admit.
What do they know that we don't? Huh?
Yeah, and you can link it back to other conspiracy theories, right? That the last couple of months is like almost proof that what China's doing on building SPR is necessary, because you can see the hawkishness building up against some of its kind of prime suppliers, right? Now it's Iran and now it's Russia these days. And that's kind of what the SPR is there for, right? In case of big outages to supply.
Yeah, at scale.
At scale, yeah.
Yeah, that's a very good point. And honestly, I think we could debate for ages without getting a clear answer on that. But it makes sense. I see what you mean. So the remaining theory would be that they're anticipating these additional secondary sanctions, Russia, Iran, etc., and protecting themselves around that. Which leads me to the next element. Obviously we had the news this week about, which is sort of linked to oil, but Russia, Ukraine, etc., is Trump escalating a bit more the pressure on Russia. And in this case, the victim is India. India, we've talked about it in the past, had a privileged position of being somewhere in the middle between the West and BRICS, if you want to call them in one way, and were friends with everyone, and they were protected. And now for the first time, they're not. And now they're facing potential secondary sanctions because they've been supporting Russia and their war indirectly by buying oil. What people tend to forget is that we actually, as Europeans or Westerners, were asking, in a way, India to buy that oil so that the flow of Russian oil will remain. And it was just, we as Westerners would not be buying that oil, but someone else will, but so that we didn't have an oil shock, or an economic shock. But now the rhetoric or the strategy around how to put pressure on Russia has changed. Let's not forget that at the time, pressure was on Ukraine so that Trump would bring Russia to the table. And Putin is saying, thanks, but no thanks. There's no table here. So now they're trying to put pressure back on him. What do we make it out of this? This is, you get so confused. You hear so many stories, and you have this famous taco. Trump always chickens out. But if he doesn't, this is a dramatic impact, because who else is going to be buying Russian oil? Where is it going to go? And can this have really a dramatic impact on flat price?
Yes, it can. I guess on flat price. It's sort of like what's the scenario going forward? How do we start this? So let's say he does it. Who would test whether or not they're going to get more sanctions by buying the surplus? There's only one player left, right? Because Brazil are not going to tempt the ire of more sanctions from Trump. China's the only one left. And then we were just discussing internally, what will happen. So it's 2 million barrels a day that India takes. We're tempted to say, okay, there's a transition period where India kind of rejects all this crude, and the crude piles up on water, and you start to get the headlines about, Russia's going to have to shut in production because there's nowhere left to go. And that, I think, is the reason that flat price can still be impacted from that. But on the other hand, as is always the case in the oil market, when the price is right, the oil will flow, right? So what needs to happen is that the Urals diffs need to plummet, and then the Chinese will take it. And the only thing left that we discussed last week, or yesterday even, was, can China build at that rate stocks, because they kind of have to make room for a lot of Russian oil. They'll have to eject some other crude somewhere, but it just seems like a lot of volume to immediately move over to China. Is that a fair statement?
I think so, but like most of the time when people hear about this in the market, what people talk about is, oh, if China takes euros, what are they gonna like eject out of the system to take all of that in, right? But like my argument when we were talking, yesterday internally is that if your diff on euro is say I don't know like -30, and Brent is 70, so in terms of flat price you're at 40. That's the level at which they're like, okay, maybe we should take a lot of that into the SPR, just dump it there, and forget about it for a couple of years. So that's definitely something that they could do, and I think they do have the spare storage capacity to do that. And what that means is that they can take all of this, like additional volume without necessarily ejecting, like the crude alternatives of the system. So
yeah, but for a short period of time. I mean,
well, I mean, it's 2 million barrels a day. Like say it's 3 months, 90 days. That's like that's 180 million barrels. It sounds a lot, and it is a lot. But for a country like China with massive capacity for the SPR, I think I don't think it's like impossible, right?
So, but this assumes the situation where it's a 3 to 6 months kind of scenario where you put pressure, Russia goes back to the table, and you get a deal. But we know with Russia is that they are extremely resilient and they will keep going, so a certain extent. So let's assume that it actually takes longer than that. Then you do need to have to start displacing. And the market will anticipate this. Maybe you want to have the proof of it, and maybe it takes 6 months before it reacts. But maybe smarter people will start taking those positions earlier. But how are we going to see that?
I'd also just be slightly cautious on the assumption that they really could logistically absorb that extra 2 million barrels a day into the SPR. Just not whether they could build 2 million full stop, but because they have already been building SPR throughout the rest of throughout this year so far. So it's not 2 million barrels a day building, it's 2 million plus whatever they've been doing already, on top of a global oil balance which is supposedly lengthening. There's more OPEC barrels coming back in. So just I'm not sure that kind of mechanism that we've been talking about of China mopping up all surplus is logistically feasible if it's more like probably 3 million or even more that they would need to be building in this scenario.
I tend to agree, Phil. I think it's too much to ask, basically, for China to immediately mop everything up. There's a transition period where you need
definitely.
Yeah, and China will eject some spot crude, right? They'll eject Brazilian, they'll eject WAF, so it's not impossible. But I think it's a tall order, and I think flat price will definitely go up. And the other thing is, sorry to hijack this now, but what Russia have done at several points in the past is when threatened, they do other things. Like, do you remember the inspection of the SPMs at CPC? They basically they'll start to threaten CPC, and that's $1.5 million. They have ways of making life difficult in the oil market, let alone in Ukraine.
There's also a lot of kind of OPEC plus politics to be played out as well, right? I think core OPEC are slightly their loyalties are going to be tested either way if that scenario really plays out. OPEC Plus has been very, very important for core OPEC over the last few years, helping them to get back to kind of stable outright prices. But obviously core OPEC and the US have been getting closer under Trump as well the last time.
So conspiracy theory collapse of OPEC Plus ahead of us.
Yeah,
that'd be good.
Yeah.
That's a nice one.
Something of the OPEC Plus or of OPEC itself?
OPEC Plus, I guess.
OPEC Plus in this case. I think Trump, whether it's Trump or other officials of his administration, I saw a couple of days ago talking about their theory now being that kind of to get Russia to the table, you need lower oil prices. So
we're seeing that with OPEC, no? I mean, they increased the quotas and the production.
Yeah, maybe core OPEC can hand in on that one, but they're not going to make friends in Russia doing it.
And moving on to products, because it's not just crude, but it's also products. How are we going to see the impact on that? Naphtha, distillates, fuel oil. What do you think is going to be the next course of action then? If, of course, this actually happens and we're starting removing people like India from that play.
Yeah, so I think assuming that this is a specified kind of goal, or the secondary tariffs are really applied and it includes products, I suppose we can go kind of top of the barrel to the bottom of the barrel maybe quickly. On naphtha at the moment, we still get almost all Russian naphtha goes east, and a lot of it ends up in the AG. A lot of it is used in gasoline blending in the AG. So we talk about that when we talk about gasoline. But then there's a lot of Russian naphtha already going to China, but there's still a lot going to Japan and South Korea, I think. Japan, South Korea, Taiwan. So especially kind of petchem, there's a petchem grade, and broadly speaking, there's a petchem grade and there's a gasoline grade of naphtha that's coming out of Russia. And that petchem grade in particular will be very attractive into China, but will be, again, another scenario where it's going to have to displace flows from elsewhere. And on the gasoline side, the AG obviously has taken a lot of advantage of having access to cheap Russian naphtha recently. And the question is whether or not someone like the UAE is going to want to kind of risk the ire of those tariffs. I would suspect not, in which case that's a particular kind of gasoline spec of naphtha, or a kind of a heavier spec of naphtha, which can probably only make its way into maybe some African outlets, maybe North African, West African outlets, who might try and kind of sneak under the radar of kind of US tariffs in that respect. But it's all a bit wishy-washy, I'm afraid.
Again, on a short term, as you said, Neil, if the price is right, there's going to be buyers, but it's getting more and more complicated. Let's put it that way. So on a sustainable basis, then it becomes really problematic.
Yeah, and then you're taking, I suppose then you're taking refinery runs out of the Russian system at the end of the day. Kind of the kind of medium-term conclusion, if they're not finding buyers, is that you're reducing oil demand in that respect.
I'm sorry, I'm going to skip ahead a little bit here. I know that we could look at the use case for fuel oil, etc. But in the interest of time as well, and for us to look at the other conspiracy theories and other wildcards. But what if the spare production capacity in the market becomes low or is low? What will happen there?
Yeah, I can go with this one because it chimes in with the stuff we're talking about, obviously. I have the feeling that the market is also very relaxed about spare capacity, right? So as we know, OPEC have just rode back on, in theory, kind of 2.2 million barrels a day of production cuts by the end of September. And there's a big chunk left. But I think the point is that people look into the past and kind of see how much OPEC have produced in the best of times and then think, okay, it's fine. There's plenty of capacity to come back. But a conspiracy theory, if you like, would be that actually it's much less than you think, and all the spare capacity is basically embedded in Saudi Arabia, and everybody else is kind of producing close to where they are, close to max by now. So in theory, Saudi can produce 12. It's likely to do much less than that on a sustained basis. They can kind of produce 12 for a few months. Is always kind of the rule of thumb. And if there's a massive impact on Iranian crude, on Russian products, it's not immediately obvious that OPEC can backfill all of that. And the backdrop is we've also had a good period of growth for non-OPEC supply. That's about to kind of drop off after this year. We know that US shale is about to kind of drop. We had the Diamond CEO statement yesterday basically saying OPEC, so US oil output is about to drop quite precipitously. So it's kind of fun to think about it. We might be, by this time next year, in a particularly tight place that OPEC cannot really deal with.
Sorry, I guess you were cueing me to continue then.
I guess.
So just let that sink in, guys.
Let that sink in. Okay, it was that kind of moment. Mic drop kind of moment. Okay, sorry, yeah.
But just from my, I agree certainly on core OPEC, or the rest of core OPEC, and having kind of little additional supply coming. Is that also then the case for places like Brazil and Guyana? I haven't been keeping track on those. I just, in my head, I thought that those were kind of steady growth for the next few years at least.
I think that the Guyana growth basically is strongest this year, and there's a bit next year, but it slows down, and it's the same with Brazil. So the sort of net impact with the US is that you don't get a lot of non-OPEC growth from next year onwards. So yeah, limited, okay. Let's say, from there.
And what about refining? Are we actually in a tight spot?
I think we're in a tight spot. You guys can feel free to jump in, but hasn't this year kind of proven it? So now distillate is very much repriced versus last month, but it has taken a certain amount of big changes, right? You can see that the regrade had to get really weak, and that has produced in the US stats quite a big swing between jet and gasoline towards diesel. So on a net basis, we've had to just kind of like change the mix of products. And what we've had to do also is bring China back into the mix. So China has, in theory, lots of spare capacity. It doesn't always want to fulfill that role, but it's taken another like chunk of export growth for distillate, for example, out of China to try and cool this market. I think we've proven that we don't have loads of spare capacity, and we've shut down a bunch of stuff in Europe, we've shut down a bunch of stuff in the US, and we've replaced it with, in theory, refineries like Dangote and Dos Bocas, who have already quite a checkered track record, right? They're not functioning on a, let's say, very regular basis that you might expect in US and Europe.
No, there's another, just as a little pet peeve for Hua and I, there's another RFCC out, a 15-day RFCC outage at Dangote, second half of this month, that's been just been announced after they assured everybody that there wasn't going to be any turnarounds before December or even next year. So it kind of goes in line with what you're saying, Neil. I'm not sure. I suppose tight is relative, right, on refining. It's not as tight or as strong as it has been in 2022 and 2023, and it's probably not going to get back to that level anytime soon unless we have kind of some of the stuff we were talking about before, taking Russian stuff out of the market completely or further. But we're not in a kind of super well supplied market as we were in, let's say, 2017 or something. And I think, yeah, at least in naphtha and in gasoline, we've kind of been following 2019 pricing all year, and with more closures on the way, kind of more closures than new capacity in the West, certainly for the next 12 months or so. It's only going to get tighter. I don't see it's not fantastically strong at the moment, but the outlook kind of medium to longer term is not a bad one.
I could maybe sort of challenge on whether we're tighter than, because the sort of pricing in post-Ukraine was very inflated, right, and not necessarily to do with fundamentals. And if you look at US stocks this year, like US product stocks, for many weeks they've trended below 2023 levels, right? So on the level of inventories, you do look tighter. And I've got one more conspiracy theory to add there. If I was OPEC, first thing I would do is not max exports going forward, and I might do something like, well, I'm going to export more crude, but I might export less product. And that's an element of the market that never gets talked about. It's like total product plus crude exports out of the Middle East, whether that's kind of on target, let's say, and fair. And if I was them, I would probably dial back on product exports. Why not? Because it helps flat price.
Isn't a lot of the diversification from kind of the big NOCs in the region, though, towards refining? So it would be difficult to kind of square away for someone like Aramco, I think.
Yeah.
Sorry.
Nonetheless, you have control. You have control domestically, though. You have to control domestically.
Yes. Yeah.
So, last topic for today. We have a choice. You guys want to talk about wars, conflicts, geopolitics, and end up with a little bit of a wider kind of discussion. You want to talk about a very, very, very focused topic, which is RBOB heating oil reversal. What do you want to do? I'm just mindful of time here.
Who wants to go?
Let's go war.
You've written up a bunch of stuff. We might as well go full
war's
conspiracy.
Okay, let's go on.
Interesting, right?
It's the theme of today.
Let's go for it.
It is the theme of today.
Well, yeah, obviously, there's tremendous amount of uncertainty still. Trump came in, said that he was going to end all wars within 3 days, and to be honest, he's done a lot of the things that he said was going to do: tariffs, AI, and crypto. There's a lot of things that he's done. Okay, but on the war side, it's not as obvious and not as easy. We have a lot of conflicts going on. Ukraine one being the number one. What is the status? What is the next steps? What's going to happen?
Well, obviously, when it comes to war, you can never really tell what's going to happen next, right? So, but what we have seen recently is you've got a lot of, like the sanctions and the rhetoric against Russia that have ramped up significantly recently. So we talked about the additional tariffs on India, the 8th of August sort of deadline for a ceasefire, or you get secondary sanctions. You've got like redeployment of some of the nuclear subs. Well, details are not so clear, so we don't really know what's going on there. You've got firmer aid commitments to Ukraine. You've got like these Patriot air defense systems that you're going to send over there. What is this kind of ramp up is, like when you think about it, it's very noticeable, and it feels, like, personally to me, it feels very coordinated. And it sort of makes sense because this year you've seen Russia, like they've regained the momentum with all the territorial gains this year, and like their logistics have remained surprisingly resilient after all these years. And one thing that like sometimes we always talk about, what about the domestic situation, Russia, etc., how is that going to impact the war? But one thing that like people forget historically is that historically and also culturally, the Russians have shown an extraordinary ability to endure very high human costs and extreme sufferings without breaking apart. Like we saw that like during World War II, after that, before that, throughout Russian history. And this is the one thing that we must like never forget. So on the flip side of that, like everything, it sort of makes you wonder whether NATO is starting to factor in, and this is my conspiracy theory, like they're starting to factor in the fall of Ukraine as a real, although still remote possibility. And really, that sort of implies a shift in their sentiment from a Ukrainian victory to now more like a negotiated sort of peace with very significant concessions. So the ramp up in the sanctions and the rhetoric against Russia is sort of like NATO's way to have as much leverage as possible going into this negotiation with Putin, because they know that there will be no Ukrainian victory. So you need to have as much leverage as possible, knowing that, like there's not going to be a Ukrainian victory. What else? And Russia's goal, I think, is like for now, they probably want to secure full control of at least the southern part of Ukraine by the end of the year, or maybe the first half of next year. And, like if you get control of all of that, you have full control of the Black Sea from both the Crimea and Odessa side. And what that means is that, you've got much better, much more stable logistics, much more defensible. And all in all, I think, like personally, my conspiracy theory is I give probably a mid to decently high probability of like the Russians taking at least the southern part of Ukraine in the next, say, 6 to 12 months, and that is going to open up the road to Kiev like a lot wider. So really the real choice for NATO right now is between that scenario or a negotiated peace right now with the currently occupied territories as the concessions. So it's like we're not talking about Ukrainian victory anymore. It's like between two hard choices.
I have a question on that one. If that happened and there was a negotiated peace, do you think that the EU would start to buy Russian energy again?
Yeah, I was going to say the same thing. What does it mean for the relationship with Russia in the future?
Or let's put it into US and EU. Do you think? Because I don't think. Yeah. You shake your head, Phil. I think the same as you. Don't think they would, but they might if it's part of a deal. And then what are the chances that Trump would be like, oh, yeah, sure, we'll take all the Urals, we'll take some diesel. No, they wouldn't take diesel, but you know what I mean?
Yeah, I certainly don't think that the EU is going to be taking Russian energy anytime in this decade, regardless of outcome, unless there's a really strong pressure from the US to do so. But as you said, US is a different kettle of fish there.
I mean, I actually see the US changing, Trump is more of a businessman, and he would say, okay, we have a deal, and part of that deal is that you give us cheap oil or something like that. I can see that happening. It's more around Europe. Europe is still very much on a moral pedestal and, giving lessons to everyone left, right, and center. And I just don't see that relationship, going back to where it was so easily. There's going to be so many political pressure on, and again, look at any kind of government in Europe. It's so shaky. The first person who lifts their hand saying, yep, let's buy Russian oil again, they're going to get so much pressure. I just don't see that happening. It's going to take a lot of time. That relationship is very much broken right now.
Agreed.
So,
Agree.
So I get your point, Hua, that I see the, ultimately, but I want to push that conspiracy theory even further, and I would like to say that in a way, what Trump wants is to let's just get rid of this whole Russia-Ukraine problem, and we can focus on the real problem, which is China. Because China is the only one that actually can put pressure to them as the superpower. The omnipresent power right now is the US, and the only one that can challenge that is China. Right. And they want to focus their attention on that, but they cannot because there's Ukraine, Russia, there's instability, there's oil flows, all these things. But so the way I see this is that, yes, I agree, there is a willingness to get, a negotiation. But this is, something that Trump has said even before he got into power. He wanted to have a negotiated exit, and there was no way on earth that Ukraine was going to be able to win this war, and they would have to give away 1/3 of its territory. And they just want to accelerate that by, putting more leverage on Russia to come to the table in a different kind of way, so that we can get rid of this topic and move on to the next one, the real one. I think that is what's happening. But in terms of what does it mean for oil going forward, I can see the use case of US saying, okay, you're back in, let's buy.
And then, to be fair, it's perfect for the US system too.
Exactly,
back in the day, a lot of it used to go to America, and I do fuel oil, and on the feedstock side, it's just perfect, that kind of thing. So
and then Europe gets in this, again, the loser here that ends up in a situation where you can see from the port of Rotterdam, you can see all these ships going from Russia to, and you're like, hey, it's here.
And they come back a month later as diesel at the Gulf Coast.
To sell it back to you.
Absolutely, at a much higher price. And
it's not as far as India, at least.
I need to get a US passport. Yeah, God. No. I mean, I can see that happening. Anyway. I mean, and if you think about that on a global stage, we have absolutely nothing to say as Europeans, to be very honest. Even in Gaza and we have absolutely nothing to say. Even, Israel doesn't give a shit about what we have to say about what's going on, and they will only listen to Trump. But anyway, I think this wraps it up for today, guys. Enough of the conspiracy theories and easy breezy kind of conversation. But so the winner is US, the loser is Europe. We all knew that before this pod, and.
Same as always.
Same as always. Let's see if we can turn this around. Anyway, guys, thank you so much. Special episode for today. Congrats again on the first year anniversary, and to many more years.
Thanks all. Cheers.
Thank you, guys.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.